yeah, this seems like a shit show. I wonder how many more shit shows there are under the surface right now where there's a crazy market maker doing a crazy thing and a team that didn't know how to negotiate it correctly. And there's all these bad terms and all these bad incentives, and it's just a fiasco. And now that I think the world's a little bit more clued into like what are market makers and how they work, hopefully we have more stories that come out about like what's actually happening under the surface, because right now there's just so little transparency.
Not a dividend.
It's a tale of two clans.
Now, your losses are on someone else's balance sheet.
Generally speaking, airdrops are kind of pointless anyways.
Unnamed trading firms who are very involved.
I like that ETH is the ultimate Ponzi.
DeFi protocols are the antidote to this problem.
Hello, everybody. Welcome to the Chopping Block. Every couple of weeks, the four of us get together and give the industry insider's perspective on the crypto topics of the day. So quick intros. First, you got Tom, the DeFi maven and master of memes.
Hello, everyone.
Next, we got Robert, the crypto connoisseur and czar of Superstate.
Good morning.
Joining us, repeat guest, we have Evgeny, high-frequency hustler and head honcho at Wintermute.
Hello.
And I am Hasib, the head hype man at Dragonfly. We're early-stage investors in crypto, but I want to caveat that nothing we say here is investment advice, legal advice, or even life advice. Please see choppingblock.xyz for more disclosures. So it's been a week full of interesting news, and we wanted to get you on, Evgeny, because you are, of course, the mastermind behind markets. You're controlling everything behind the scenes. We know all prices are decided in the Wintermute morning huddles. And so we wanted to understand what's going on in the markets, and specifically around the story about movement. So we've talked a little bit about movement on previous shows. Movement is an L2. Well, it was, I guess, an L2 that's becoming an L1 or something. Anyway, the reason why it's so interesting largely is because it's been embroiled in a series of scandals. And those scandals are something that people have been whispering about behind the scenes, but now everything seemingly has come to light. The story was broken by CoinDesk on a couple weeks ago. But the story began in November when a company that was affiliated with Movement Labs, which is the company that developed Movement, signed a deal with a group called Web3 Port. Web3 Port is a market maker, apparently kind of shady market maker. And this market making agreement involved this group, Web3 Port, basically having an agreement that they were going to be able to liquidate their tokens that they received as part of the market making agreement if the fully diluted valuation of Movement was above $5 billion. And all the tokens that they sold, they were going to split the profits 50-50 with the foundation, basically meaning that this market maker, quote unquote, became an agent to dump the tokens if they were able to push the token price up. That's effectively what their incentives were. And this was a deal such that not just the market maker was making money, but the Movement Foundation itself would receive the proceeds, which obviously is extremely shady. They also received 5% of the total supply of tokens, which is a massive amount of tokens relative to what the flow was. I think the flow was less than 10%. So this resulted in a story we covered previously where they dumped $38 million of Move tokens, and that resulted in Binance banning the account. Now, everybody involved in Movement initially refuted and said that this is not true. This is all a lie. This is FUD. This is people coming after us and a bunch of anons trying to take us down. Eventually, once CoinDesk reported on this and brought the receipts, as well as all of the contracts that were involved with this. So apparently there was a lot of leaking going on from people affiliated with this. This has resulted now in Rushi, the co-founder as well as the CEO of Movement Labs, getting fired. Previously, it was claimed that he was supposedly placed on leave. He denied this. There are just nonstop denials coming from the team that all of this is fake, all of this is FUD. Now, finally, it seems to be, the chapter seems to be closed now on Movement. They're now getting a new team. There's now a new organization that was built called Movement Industries. It's all very confusing, but long story short, Movement has been down only. There's been a lot of reckoning seemingly within the industry about how was this allowed to happen, given that this was backed by a lot of large VCs and was a project that was getting a huge amount of attention in all of the, call it, marketing that they were very successfully doing and all of the clout they were throwing around, largely silencing a lot of the critics on crypto Twitter who were claiming that, hey, there was something weird going on underneath the hood. So, Evgeny, I don't know if you guys had any direct relationship with Movement, but want you to help explain to us what is all this? How normal is this? What is weird about this relative to a normal market making agreement? So help us understand in the context of market making what happened here and how you understand this story.
And before that, I just want to disclose that Robot Ventures is a very minor investor in Movement, although we had no idea about any of the stuff or contracts or market making, and we're not included in that.
Yeah, I think I'll start with basically it's a very non-market it was a very non-market agreement, right? I think Vasilor posted quite a few snippets of it and his Telegram thread, and he did pretty good overview as well, and he kind of described how he was trying to fix it. But like your standard market making agreement, it always has those like KPIs, basically uptime, where you need to market make, spread widths, like how much you put in the books, for example, basically all those kind of things on one hand. So that's kind of like obligations of liquidity providers, market makers, whatever. And on the other hand, basically is a carrot. So what do market makers get from it? And typically it's this call option kind of structures where effectively at the end of the agreement, market maker can return instead of the token loans, they can return the basically stable coins or dollars to the protocol at some strike price, which nowadays is, I would say, 25, 50, sometimes more percent above some TWAP from after the launch. Basically, that's how it typically works. So this contract was very non-market in that it didn't have a call option. It didn't have like anything like this. Basically, it had this like really weird incentive to push the token up, because once it crosses 5 billion, then basically the protocol and the market maker would split the proceeds between each other.
Hold on, let's take a step back, because I think a lot of people listening to this, maybe they know what a market maker is, or they've heard that market makers are important, but it's maybe just worth kind of setting some understanding for folks who aren't as close to this, what market makers do and how they're involved in the process of a token end up getting listed, right? So normally, if you have a token, you just launch it on a DEX or whatever, something like this, then all you really do is you're seeding an AMM pool, right? But when you want to take your token onto an exchange, you want to launch on Coinbase or Binance or whatever, you don't just launch your token and then hope that people show up and trade it. These exchanges want there to be liquidity all the time. In order for there to be liquidity all the time, someone has to be willing to buy, someone has to be willing to sell. And usually the people who do this are market makers. And so a token issuer is expected to strike a deal with a market maker like a Wintermute or one of these other large firms. And those market making agreements are some kind of agreement that this market maker will provide some kind of uptime, like you said, spread, and in exchange, the market maker is getting paid. Because the market maker isn't going to do this for free. They're taking some risk, as well as they're having to put up some money in order to do this. And one of the common ways in which this is done is by, one, the project will often loan their tokens to the market maker. So the market maker has inventory. They have tokens to actually market make with, but they also get paid in some way. So they could get paid cash. Sometimes they also get paid in this option structure, such that if the token is successful, then the market maker gets to keep some of the tokens at a price that is fixed in advance, but is above where it is going to be initially listed at. So, Evgeny, help me understand. Let's say you're a market maker, which obviously you are in many cases. Why isn't this the incentive for every market maker, right? You have an option structure. There's a strike price. Why isn't your incentive to manipulate the price up for everything?
Yeah, I mean, you can say there is a incentive for anyone having, why is there no incentive for you guys to pump the price of your protocol companies, for example? Like
many people think that is.
Like it's like there is definitely an incentive. Like the question is like how big the incentive is in this case. Like in our case, like okay, we might get like 0.5% of supply sometimes, like, but usually it's lower. Like nowadays it's significantly lower. Like it really depends on the market cap of the protocol. But basically, even if you, I don't know, if you're some kind of like a market manipulator kind of market maker, you have this call option structure. You still, you push the price up. You still need the price to stay there until the expiry of the contract, because like what's often in those contracts, like at least with the ones that we do, is basically if you as a market maker don't show bids and offers programmatically, or whatever, basically the issuer, the token issuer, can cancel out the whole contract, and then suddenly you don't have a call option anymore, and suddenly you're sitting on, suddenly you pump the price, but now you kind of like need to try to sell those tokens somehow, which probably will push the price down. So like this incentive really needs to be significant enough to pump the price, but also to be able to cash out afterwards. And what was really interesting for me in this particular case with Web's report is that, okay, there was like a very clear incentive to sell above 5 billion, but there was also another thing which like put a really clear incentive on the market. Well, on Web's report is actually, as a part of the deal, Web3 port transferred them, I don't know, like as a 60 or 100 million, some like insane amount of money, which, for example, in our case, we would never do because it is just an insane amount of money. Like even if protocol gives you 5% of token supply, like as a market maker, you make money from trading. Like this 60 million, you deploy it like in perpetual strategies or market maker strategies, or DeFi, like whatever it is you do, like there is a real time, well, there is a real like cost of having this inventory on your hands. And basically, if you receive protocol tokens and in return you give like insane amount, like about $60 million as collateral, I guess, which is what it was, you have an extra incentive to basically push the price up and sell as many move tokens as possible to basically have those dollars back, because otherwise you just every day you're just losing money by not deploying those dollars into your strategies.
Okay, so there was a shady market making agreement here. This is not how normal market making agreements are structured. How common is this? How many market makers are there doing stuff like this? How many projects are there that have these kinds of agreements?
I didn't know Web3 port existed until Binance kicked them out like a few months ago.
Does that happen often where there's a new market maker you've like never heard of and they just cross your stream? Is it easy to create a market maker, shut it down, rebrand it? Like what's the story there?
Probably, but like there are so many of them that operate from Asia, for example, and we just don't see them, like because they don't advertise themselves like very openly. I don't know, Kelsey Ventures, like nobody knew they existed before this whole scandal with Millet blew up, right? But yeah, to me, it's quite interesting. Like I want to think I know pretty much everyone like significant, but yeah, those guys still keep popping up and do stuff.
But how common would you say this is?
Those kind of agreements, I think they must be very uncommon with proper protocols. I think I wouldn't be surprised if, I don't know, all those different tokens that get listed on tier 2, tier 3 exchanges only and never make it to, I don't know, Binance or Coinbase. Yes, I'm pretty sure like there is a lot of this stuff going on.
Robert, what was your reaction seeing all this stuff break out?
My reaction initially was the assumption that this is happening frequently and that the public doesn't always know how or what is happening behind the scenes, and that there's probably more drama, on a daily basis that's not reported on because it doesn't make it all the way up to the sort of CoinDesk level. And reading this, I was like, yeah, this seems like a shit show. I wonder how many more shit shows there are under the surface right now where there's a crazy market maker doing a crazy thing and a team that didn't know how to negotiate it correctly. And there's all these bad terms and all these bad incentives, and it's just a fiasco. And, now that I think the world's a little bit more clued into like what are market makers and how they work, hopefully we have more stories that come out about like what's actually happening under the surface, because right now there's just so little transparency.
I would add the one thing though, that I think it's very hard for market maker to do it outside, like without the protocol knowing. So like all those stories about protocols being, like we didn't know that how it works. I think most of the times they know. So
yeah, I mean, this was clearly a case where they knew.
Yeah,
you can see from the email chains that the foundation was like, "What the hell is this? This is the most absurd agreement I've ever seen." And then, a few days later, it's signed.
Yeah, the quotes are really choice from this guy, YK Peck. It was also the founder of Web3 Port claimed that Peck was his GC, and then Peck was like, I've never met this person, or like we talked for 2 hours. I don't know why he would claim I'm his lawyer. Like it's just like really funny, very, very choice quotes. And then obviously the whole relationship between Sam from like Zebek was sort of like this like shadow co-founder. And I was also looking like the Rentech is like headquartered in Bangladesh. So the whole thing is just very bizarre. And I'm more like, look, there's this long tail of like really shitty projects, really shitty exchanges. And I'm not surprised they get themselves into trouble. Movement was weird where it was kind of not S tier, but it's not like random nobody VCs. You have Robot Ventures, for example. Like it's somewhat reputable, kind of an interesting product. Like there was enough there to feel like someone should have been backstopping, or at least like stepped in as the chaperone and said, hey, this is not okay, this is not standard. I think your kind of point around, hey, how often does this happen, or teams don't know what they're doing, in some respects it kind of reminds me of frankly like venture investing pre YC safe, when every VC would have their own sort of convertible note, terms. It would be all sort of negotiated ad hoc. People would sneak really kind of, vicious terms into their own, individual investment contract, like having some crazy, liquidation preference for like an early stage investment. And I feel like the safe from YC sort of opened and sort of provided sunlight in this entire industry. And now everyone just has an open standard they can point to and just pick something off the shelf that they know is going to work reasonably well. And I feel like market making, in my mind, is kind of a little bit still like that pre-safe era where, if you know, you know, and you can generally get a good contract for yourself, but there isn't sort of like a safe equivalent.
Yeah, there is. I mean, there are some services that people use, things like CoinWatch, and there's others that allow them to help navigate the market making conversations, in large part because market makers are repeat players, is all they do. Whereas a team that is going to launch a token, they only do it once. And the initial time that you aggregate your market makers and get something to go launch on a big exchange is the most important decision that you're going to make with respect to the liquidity of your token. So there are good market makers and bad market makers. It is sometimes difficult when you are going through referrals or you're not really deeply networked in the crypto world to identify who's reputable and who's not. I mean, Wintermute, I believe, is the single biggest market maker in crypto, if I'm not mistaken. Is that right, Evgeny? Or you guys are top 3 or something? Where are you guys?
I mean, it depends how you look at things, I guess. Like if you're talking market making, yeah, probably. They're basically very diversified business, ultimately. Like we have a set of competitors in DeFi, a set of competitors on centralized exchanges, set of competitors on OTC, set of competitors in token market making. But like we are probably the only one that does it all, basically.
That makes sense.
Yeah.
Yeah. So the names that you've heard of are very likely to be reputable, right? They're not dumping on exchanges. They're not doing all this weird market manipulation stuff. But the further afield you go, you find some weird random Asian or Middle Eastern market making firm. There's a very good chance that I think it was Big Bird 0x aligned, what is it, 0x Balloon Lover, who pointed out that many of these market making firms in name are basically ways of illegally cashing out founders. And they sort of say, oh, we're quote unquote market making, but really what we're doing is we're taking tokens, we're dumping them, and we're splitting the proceeds with you, which is exactly what Web3 Port's deal was structured to be. I mean, the thing that's most striking about this, aside from the mechanics of the market making, which are themselves, they do warrant discussion, but a lot of the focus has been on the team and on sort of what exactly led to founders. The movement team, they were really praised for being these young, really hard-charging, vibrant, ambitious founders. And the question that naturally gets raised is, why would they do this? What causes founders to decide, you know what, instead of playing it straight, I have a successful project, I have all this momentum, I have all these people excited about me. Instead, I'm just going to dump my token and try to cash out early instead of actually shipping a product. And of course, they were very roundly criticized for a long time for launching a token before they actually had a working chain, for potentially, there's a lot of rumors circulating that they were relying a lot on contractors. They didn't really have that strong of a technical team. And they were just very, very focused on marketing over substance. And this has led to a lot of people raising these concerns that we've remarked on the show as well. Mostly rumors, right? Nobody had receipts of, okay, well, here's exactly what they did. But people were saying, oh, they're manipulating the float. They're not doing the airdrop. They launched a token before they actually had a real product. And all of this kind of pointed towards there's something untoward going on with this thing. And I guess having chatted with a few people now in the postmortem to movement, a couple questions naturally come to mind. One, what does this make you think differently about how you are going to be looking at startups or founders going forward? And what does it tell you about the incentives of founders in this industry? Is it the case that there's 1,000 Rushis out there? Personally, I don't actually think there are. I think it's one of the reasons why there was so much attention and so much FUD about movement, right? It was probably the thing at which I saw the most stuff on my timeline that was unconfirmed. People saying these things, but without actually having hard concrete proof. I don't see that about a lot of other projects. Like movement, I think most people knew, seeing everything that was being said, that probably something was going to get uncovered sooner or later. That was going to be the smoking gun about, yeah, movement is doing some shady shit. But there's from my perspective, there's not like 500 of these. There might be somewhere on page 3, listed on Mexi or some other random exchange, but certainly not in the top 100. I don't know. What are your guys' thoughts on those questions?
Yeah, I think dollar weighted, this is kind of a rare occurrence. This is why I think there's so much attention. But I was actually reading, I think it was another the Cointelegraph article talking about market making agreements, and they had some quote from some random like Web3 advisory firm, and he was complaining. And just for kicks, before the show, I was like Googling this thing, and just I feel like people maybe underweight the just like volume of slop in the long tail, and just like so many random shitty projects and people that you don't hear about and that aren't very valuable, but there's a lot of them out there. And I think, to your point, like those are the people that are then going and getting these kind of tier 3, tier 4 exchanges and market makers. But yeah, to have something so high profile, to be what it launched at like a $34 billion FDV project, experience this kind of thing. Yeah, it was, you got to hit the $5 billion, I guess, is kind of crazy.
Yeah, I mean, it's down, I think, like 80+% from where it initially launched. So, I mean, the chart for this thing has just been basically a straight line down. I don't know, Evgeny, what's your take on that question?
Basically, how many tokens in top 100
yeah, and also how does this inform your perspective when you look at the next token, right? The next token reaches out to you. You obviously don't want to work with the next movement. What should you be looking for? What should we be looking for?
I don't know, like to me, like definitely one part of the problem is I'm personally like very allergic to those kind of like very flashy, very marketing driven founders. But I know that it's definitely other way around, and like in Silicon Valley or whatever, like traditional VCs love those kind of founders usually because like they bring energy and they're like, I don't know, they're super pushy and everything, which kind of like coincides a lot of times with like them just being scammy people. And to me, like a big question, I guess my question back to you is like, how much do you see, like how big overall do you see for venture firms to basically identify and kind of like warn people about those kind of people, and being kind of like more selective and like more careful about those things? Because I don't know, top 100, I think there are definitely some protocols out there that are not great.
So, I mean, from my perspective, well, I want to hear Robert's perspective on this, but from my perspective, we passed on Movement, but we didn't pass because we thought they were going to dump tokens on retail, or like break their lockups and do all sorts of shady shit. I don't think there's any world in which you would look at a founder and say, you're the kind of person who's going to break a lockup and dump on your...
You try to screen for that, just in your initial conversations, but it's hard to screen for.
Yeah. I mean, at the end of the day, like the reason why we didn't invest was that we didn't think the tech was that interesting, right? We thought it was just a kind of derivative project. But when I met Rushi, I only met him once, maybe twice. And when I met him, I came away with the impression that I think a lot of the investors came away with, which is that very energetic, very charismatic, hard charging, very ambitious young guy. It's now kind of a meme that there was this, I think it was Blockworks that had a kind of a puff piece about Movement. And it just kept saying like, they're young and raise a lot of money, and it's kind of a meme that like,
this is a story as old as time,
I know. That alone is worthy of a pay-in to how amazing of a founder you are, that you're young and you raise money. And that's why you should be bullish.
Listen, the entire Forbes 30 under 30 is like usually like a warning list.
No, that's like a great example of that.
Yeah. Extremely bearish. So Rob, okay. So having seen all this stuff play out, what's your learning? What's your takeaway? How do you reflect on the Movement investment for you guys?
Yeah, I mean, here's how I reflect on it. And I say this as very small investors who came in not at the beginning where we would like really get to know the team, but we came in at like the Series A when it was like pretty developed. I think that they should learn from this. I think that everyone involved has to use this as a growing up experience, both in terms of like business dealing, both in terms of, transparency, in terms of, being fair, to the entire ecosystem. I just think that, eventually everyone's going to bounce back from this stronger. Is it great for Movement, the project? No, right? Does it impact the technology that they're building? No. And so, I feel like this is one of these things where, 2 years from now, we might just very easily look back and say like, okay, it's water under the bridge. They all figured this out and they moved past this and it was kind of stupid and it is what it is.
You're so optimistic.
How do you think about the bet on Rushi specifically, right? So like you guys at that stage, extremely founder-driven investment.
Well, I mean, Series A, it's less a founder-driven investment. So like when we invest in the pre-seed, for instance, it's all about the founder. We're really not often, saying like, oh, well, how scalable is the technology and this and that. It's like, it's a bet on the founder. It's a human bet. And it's like about looking them in the eyes, and it's about understanding what their ambition is, why that's their ambition, and do I think that they're going to pull it off? And it's the later stage you go, it's less and less and less about the founder. And it's more and more and more about traction. And that traction is technological traction, it's investor fundraising traction, it's all of these things. And the later stage you get, by the time you're like a Series C or Series D, it's zero to do with the founder, because they've proven themselves. And it's 100% to do with metrics, right? And so there's a gradient here. And this is one where we invested, at the Series A, a couple rounds in. And for us, like, this was not a long diligence process. They had a lead investor. The round was, if I recall, pretty much fully subscribed. And, we wrote a small check. So like from our side, if it was earlier stage, I think we would have gotten to know the team a lot more closely.
So one of the things that we were chatting about in a previous episode when we talked about the Web3 port, when the initial thing happened with the Web3 port where they got suspended from Binance, we talked about the idea of a disclosures regime for market making agreements. And Evgeny, you and I chatted about this a little bit in Dubai, but basically my proposal was that I think one way that a lot of this can be solved, not completely, obviously, because there's always room for fraud. And, if somebody's defrauding people outright and they're lying about these things, then okay, there's not much you can do to stop that. But with these market making agreements, it is, in traditional markets, you disclose who your market makers are, and you can't go public without having those disclosures. In crypto, the exchanges know who your market makers are, right? Binance knows, Coinbase knows. You have to give them that information before they'll list you. But retail doesn't know. The public doesn't know. And to my mind, like the ideal disclosure regime is one where the delta between what exchanges know and what retail knows is basically zero, right? When you are applying to an exchange to get listed, the public knows everything that the exchange knows. And basically you don't have to tell the exchange anything that you're not already disclosing to the public. To me, that's where we should be going in the long run. We're very far from that right now. And I even went so far as to say that the terms of those market making agreements should be disclosed. And that was something I think in Hester Peirce's speech, where she detailed what a disclosures regime for crypto might look like. That's something that she even proposes, that the terms of the market making agreement should be disclosed to the public. Tarun and I got in a big debate about whether or not this would happen and who would bear the costs and all this stuff. What is your thought about a regime like this? Is that something that you would vomit in your mouth and say absolutely no way? Do you think that'd be good? Do you think it'd be bad? How do you think about that?
I'm genuinely, like myself, I'm very supportive of that in general, because I think we have to get there. If basically we keep pretending that tokens are like not stocks, but they're so stock-like in their behavior. But like if you look at IPOs, for example, when a stock needs to do IPO, it needs to do such a gazillion different disclosures about market makers, about who the investors are, like about all kinds of like risks and what's not. And yeah, Hester's speech was like literally about that, what has to be disclosed. And it's not even about having parity of information between exchanges and retail. It's having it's retail basically having as much information as humanly possible to make decisions whether to buy this token or not. And we definitely didn't have that. And I think market making agreements basically is a very basic thing, like how big is the loan size and where's the strike price is like basically just essential, because then as a retail guy, okay, here we go. This is like market maker has incentive to sell above this price. So once we cross this price, maybe there will be some more selling pressure, for example. Maybe not. Maybe they'll just keep holding it. But at least like you're fully informed. And the really bad thing about our industry currently is we actually had at least one protocol that did those disclosures in the past, and that was WorldCoin last year or a year and a half ago. Like I don't remember what it was, but like WorldCoin actually did disclose the loans, it did disclose the market makers, it did disclose the strike prices. And they got all the shit in the world for this, because people just started criticizing them. Why do you create this structure? Like as if it doesn't happen with every single token. They basically got like lots of shit for it. And yeah, I don't think they really enjoyed the experience. And more importantly, all founders coming after them thought, okay, we can disclose this stuff and be like good to our investors, or we can just like keep it quiet because we don't want to get all the shit. And that's currently where we are as an industry as well, because not only there are no disclosures, but also like if you disclose, you get a lot
So
of
if
complaints.
it's voluntary, there's an equilibrium in which no one discloses, in essence. And in a regime in which it's mandatory, which is, as we've been talking about, how registered securities work, everyone does it, right? So do you think that we have to have a requirement in order to sort of make that transition? Or do you think there's any sort of like, we'll call it self-regulatory steps that could be taken to actually get issuers to disclose market making?
I thought about it a lot. Like generally we could like, I don't know, us, GSR, Seleni, flow traders, whatever, like all others, like we could in theory like get together and say, okay, like from now on, like we're going to disclose it. And for us, well, basically for those market makers who disclose, I think it would be ultimately very beneficial. Like I do think it would be beneficial because I do believe we can push the market into this being a lot more normalized, because it's all about creating norms. And once you're creating those norms, and basically all other market makers are kind of either forced to follow those norms or say, okay, we're just not going to do it. And protocols also either to follow those norms or not going to do it. But it's a pretty difficult coordination problem. So if you don't have SEC forcing this on us, or like saying, like it would be nice if you do it, it's just really hard.
I tend to think there's three channels through which this could effectively get normalized. One channel is through the exchanges. That would be the easiest, is if Coinbase, Binance, they basically decide if you want to get listed, you have to disclose. And that would just mean that everybody discloses because they want to get on Coinbase or Binance. You have to disclose before you even list, right? So you can't, wait until you agree to the, yes, we're going to list you, therefore now you have to disclose. You have to disclose in advance to even apply to get listed on Coinbase or Binance, in which case, okay, now everybody's going to disclose because they want to get onto Coinbase or Binance. That would be the easiest channel. The second, I think, would be through the VCs, right? Because there's a small number of high status VCs, and all those high status VCs could basically all agree, we're going to have a standard disclosures regime that we just push onto portfolio companies. They have to do these disclosures. It's like in a side letter or something. The third is through market makers themselves, right? So the high status market makers, the ones that aren't afraid of publicizing their market maker agreements, they could all decide, we're going to collectively agree. And if you're working with a market maker who doesn't disclose, that's kind of shady. Now, the problem with the market makers agreeing to do this is that if there's no forced disclosure of all of your market making agreements, then you could have one or two, you could have one non-shady market maker and then also have Web3 port, right? For all I know, that's what Rushi did, is that they probably didn't just have one market maker, right? They probably had multiple, and one of them was basically the dumper. So you do need, I think, some uniformity in order to solve this problem, is that all the market makers are disclosed, and the exchange knows, right? Because the exchange sees who's trading the asset. They see who's providing liquidity. So you can never run it by an exchange without the exchange knowing. So if you're Binance, you're Coinbase, you're the primary liquidity venue for an asset, you ultimately are the primary enforcer. I think the last option is to wait for the SEC to do it, because I think the SEC is going to take way too long, and the disclosure regime is not going to be in the shape that we want. And at the end of the day, I think it's better for the industry if we step up and also create the disclosure regime that makes sense for us, right? If you try to synchronize it to traditional securities, you get two problems. One is that you're going to get a lot of disclosures that are a huge waste of time that nobody cares about, that are these kind of performative or more pure ministerial disclosures that don't really matter for any real purchaser. And then second is that you don't really get this kind of fine tuning of what is the trade-off between the cost of disclosures and the value of the disclosures. And I think as the industry, we're in a better position to be able to do that. And then lastly, I think there's a sense of like, oh, disclosures, does that mean you're basically agreeing that tokens are securities? And I think it's worth like exploding this thought early, which is that disclosures are good for everything. It's always good to do disclosures. It doesn't mean that you're a security or not a security. There's a lot of things that aren't securities that also disclose things about themselves. So at the end of the day, more disclosure is good. And we can just say that, no, this has nothing to do with whether security or not. This is just how you get on exchanges. If you want to get a token on exchange, you have to do these disclosures. It has nothing to do with securities laws, and it doesn't imply any analogy between this thing being an unregistered security if you agree to disclosures about it. That's my take. Clearly, when something gets listed, almost always there's a counterparty who is negotiate, whether it's a foundation or whatever, somebody who even just has a lot of tokens, and even if they're not directly affiliated with the project, almost always there's somebody who's on the other side with the exchange who may just be a quote unquote representative of the protocol, even the protocol is already fully decentralized. And whoever that person is who's lobbying to get this thing listed, let's just say that person, whether or not they're the quote unquote issuer, is going to be the person making some of these disclosures to help the thing get listed and get liquidity. So I don't know. I'm of the view that I think as an industry, we have to grow up and we have to just get ahead of these things before we start to really lose trust with retail investors. Because these kinds of stories, ultimately what they do is they erode confidence in the whole token industrial complex. People look at something like Movement. I mean, Movement is just one token, right? But even one token that has this much attention and has this much force on social media, people see like, oh, that shit is happening. It's like the Kelsier Ventures thing, right? How many people would just said, you know what? I'm done. I'm not trading meme coins anymore if this is the way that they're made. I don't know if I'm buying, if my next meme coin is also from Kelsier Ventures or from Kelsier Ventures Prime. How many of these firms are out there? How many of these tokens are like this, right? With something like Movement, it's not just, okay, some people lost money buying this token and they got dumped on. The problem is how many tokens are out there? I really actually don't think it's that many. I think there's maybe, 2 or 3 of them that are on page 1 that are like this. There's a lot on page 3, a lot on page 4, I'm sure. But if you're on a top tier exchange, yeah, the founders, the ones that we back, they don't do shit like this. They're not getting rich, dumping their tokens on day one. Like that's insane behavior. So, but the only way people are going to have confidence that that's true is if there's a robust disclosure regime. And right now, we're not really close to having that yet.
It's not only the market maker agreements that needs to be disclosed. Like there are lots of other things, like basically what's disclosed again in TradFi, like any significant transactions. Like if you're
anything material to whether or not someone wants to buy or sell something, right? And like we finally have as industry gotten to the point where some things are being disclosed to everyone. What's the token unlock schedule? That wasn't a thing a couple of years ago. Everybody was like,
well, token unlock schedule, but also what is the cost basis of all investors, for example?
Just sure, that's a great thing that I wish was disclosed across the board, right? So few projects disclose the cost basis of where people invested.
Yeah, no, there's a lot of wood to chop here in creating the right disclosure structure. But I also the other thing I guess I want to say is there's one of these areas where I don't want the perfect to be the enemy of the good. Is that people bike shed and they can spend all this time arguing about all the little details of what's the exact right thing. But the problem of trust in the whole market, especially in altcoins, is I think has a risk of metastasizing. And so I would strongly encourage anybody who's thinking about this seriously to try to move fast rather than trying to get it perfectly right. Because you can always iterate. You can always improve on things. And it's very likely that whatever the industry arrives at, regulators are going to build on and add to or accrete to or formalize. But the best thing that you can do as an industry is to get there first and to show good faith, not just for regulators, but more importantly for your own industry, right? Just to gain confidence of investors. So let's switch gears a little bit here and just talk about market making generally, because, putting the whole movement labs thing aside, there's been a lot of FUD lately about market makers, and I'm as a VC, I'm a little bit relieved because there was a moment that people thought VCs were the villains. Now people are pretty convinced that market makers are the villains.
There's gonna be a new villain in a couple of weeks. I don't know.
Well,
the devs.
Everybody gets their turn. Everybody gets their turn. But right now it's market makers. You guys have been getting a lot of heat for the claim that you guys control token prices. There's been you guys have been market makers in stuff like
they
meme
do
coins.
Control token prices, right?
Of course, they're stand up every morning.
So
that's right. So help us understand, one, how true is this, and how can we be convinced that you guys are not controlling token prices, right? Like how much control do market makers really have over how these markets go, and what do you say to the people who say, look, the moment that Wintermute shows up and starts market making something, it only goes down? That I think I've seen like 500 threads claiming that, here's where Wintermute started and here's where the token is now. Wintermute, you've destroyed another one.
Well, the funny thing is, like, I think 9 months ago, it was last way around. So it was like, okay, here's like the graph and here's like a Wintermute graph. So yeah, now they're market makers and that will go up. So the most basic thing is just very, like all those like kind of FUD, it's very cycle specific. So like if it's a bull market, people believe that market makers are pushing prices up. If it's a bear market, people believe that market makers push prices down. And actually we were definitely a villain 2 months ago. It's actually the FUD is like really, really low now. Like I don't know. I think people are searching for the new one, for the new target. I'm definitely getting like way less hate compared to like 2 months ago on Twitter and just in general. But back to your question, I think it's part of it is definitely a cycle. So I mean, most of this FUD quite obviously coincided with basically Trump presidency not resulting in like super mega cycle, but something as
I don't
around.
know. As of this hour on Thursday, May 8th, it seems like the super cycle's back.
So yeah, like maybe Wintermute is back as well, doing it as around now. So like maybe we'll see more love now. Who knows?
Yeah.
But
Well,
so
thank you
on one hand,
for
it's-
deciding in your stand-up to make prices go up today. We really appreciate it.
Yeah, we appreciate that.
But like on one hand, it's just basically people trying to make sense of the world around them, and it's instead of I don't know trying to understand how the market structure works, how the float works, like how generally many things are correlated with each other in financial world and tokens as well. It's kind of easy to find like somebody to blame. That's like the most basic thing, but I don't know. To me, kind of like the saddest thing about this is just like how little people think about this and how little people understand, because like there were a bunch of threads being written about. I don't even understand fully how it works still, because it's literally flat earth kind of logic. But basically Binance sending us tokens and then us selling those tokens to crush the prices so that Binance can profit on liquidations, something along those lines. Which basically knowing both our model and Binance model is kind of, well, it's pretty stupid, because both us and Binance, we make a lot of money on retail investors because, well, Binance, I think more than us for sure, simply because like those are the guys that pay like they're in the highest fee tiers, they like pay a lot of fees. And for us, it's basically the best flow we can possibly have on screen. Basically, it's what's called uninformed flow. People just buy, sell, how we perceive it randomly, basically, and they don't really push the prices up or down. So they are like the best flow we can possibly have. Like we want retail to stay not broke as much as possible. We don't really want retail to die. But yeah, unfortunately, like for the past like in December, January, February, like there were so many of those cascading liquidations that retail is flushed out. Like January was a good month for us trading wise. February, March, and April were not so good months for us trading wise, because it's just not much happening. Like everyone is sidelined basically.
So when retail activity dies down, that's when market making is less attractive. And right now, you're saying you're not seeing a lot of retail flow going through all your venues.
And it's not even linear. So it's if volume goes down 50%, we don't make 50% less. We make way less than 50% less.
Right. Because of the fact that, retail is totally gone and vast majority of the flow is informed flow. So, okay. One question I've always had about market making in most assets classes. So if you're trading stocks or bonds or whatever, prices, for retail, it's mean reverting, right? So there's a fundamental value to the asset, and it'll most likely go back to what the true value of the asset is after retail trades it. Whereas crypto prices are kind of path dependent, and they're very momentum driven, and they're sort of autocorrelated. Something that goes up tends to keep going up, something that goes down tends to keep going down. Wouldn't that make market making against retail harder, given that these things are likely to keep moving in the same direction that retail's pushing it?
Not really. Like ultimately, our model is we have a bunch of trading venues. We have Binance and Coinbase and DeFi, and we have some OTC flow. Like we sell on one and we buy another one cheaper, and we just do millions of those transactions every day. So trending from that perspective is not that bad. Like what's bad if big liquid funds, of which we don't have that many, comes and starts buying some token, and they can push the price really like against us, and it's really hard to basically hedge in time. So we'll just get run over. So that happens, and that's actually like the other side of token market making, that like people saying, okay, you guys are making a killing on those call options. We get run over on many times on illiquid tokens that we have obligation to market make. And it's not a lucrative business in a bear market at all. Like when there is no retail interest and there is like token number 345 on CoinGecko and you have to market make it, whatever, half percent wide, which is not that wide. Like you get run over easily.
How many of your contracts do you lose money on, percentage-wise?
I'd say like intuitively, something like 50 at least, 50%.
But the ones you make money on more than make up for the ones you lose money on.
Like for us, it's a bit better because like we have a more diversified business. So like, for example, we do OTC. So being a market maker in a protocol really helps being a liquidity provider on over the counter as well. But yeah, if you don't have any OTC flow, if you don't have anything, it's almost like a venture business. You basically hope that this stuff will go up. But on one hand, it's venture business, but also it's very cyclical venture business. You don't want to be market maker when if you think that next 6-9 months will be a bear market because those call options will never be in the money. So you really want to, I don't know, speed up on this if you expect the bull market to commence like in 6-9 months. Like that's a perfect timing. But
don't you just hedge those options like as a market maker? Like you're not like saying like, oh, we hope it goes up, or like, oh,
but hedge with what? Like sell what Bitcoin? I don't know.
Sell spot. I mean, if you're the market maker for a project and you essentially have call options on it, you sell the project.
No, but that's also an interesting one because, like, let's say you have let's say a token trades at $1 and you have a call option at $2, for example. Okay, I can sell some, and then let's say it goes to $1.80 at expiration. So we sold all the way up, hedging some of this option delta, but then it expires not in the money, and we end up losing on basically all the sales that we did because we actually need to buy it back to deliver the loan back. So it's not very straightforward thing actually.
Right, but there's a lot of market makers who do and understand option pricing and option hedging and know how to properly hedge and monetize the gamma of an option, right? Like it's not rocket science. Like yes, there's ways you can lose, but in general, if the option has value, you can monetize.
It's easier if the token is liquid. It's much less easy if the token is, I don't know, number 325.
Yeah.
Right. And most of your deals are with tokens that are not,
that are 325.
Most
of our deals, I don't know, vast majority of our deals last 9 months were meme coins. And that's just, completely random. Like this,
there's no ability to hedge that.
Yeah. And also, like if you don't have a call option, if you're a market maker for those, like we also got like a lot of people think that, okay, people are short in meme coins. Short in meme coins, Jesus, that's like the most scariest thing you can possibly do. Because like, okay, if you short an L2, okay, maybe it will be like the best L2 and it will be like 2x of the next best L2. If you short meme coin, it can go 1000x and become like next Shiba Inu or whatever. Like it's like you have no control over it whatsoever.
Right. Okay. So this whole call option structure, is this a thing in TradFi too, or is this like a token crypto specific evolution?
Like, I think Robert can comment on it more. Like there are like structures sort of similar in TradFi around this, but at the same time, not really.
Yeah, I think in TradFi, a lot of the firms that are hiring market makers, they're literally like paying them some fixed fee. Like, oh, we'll pay you $100,000 a year, like for you to be a market maker in the stock, and you have to get like 3 of them so you can get listed on the NASDAQ. And it's very service providery with like very basic economics, and the market makers, they don't quote huge size, but there's enough liquidity there that whether you're looking to buy or sell the stock, you're somewhat happy.
Yeah, basically to add to that, it's also a function because like the separation of roles is very different in TradFi because you have like investment banks that like does it, and then you have market makers. And in crypto, it's like market makers kind of like also play this role of investment banker in a way, because like investment bankers in TradFi, they do get this, they're not call options, things like put option structures, which doesn't matter, but like they do have like option structures before the listing. But then they basically, they let market makers do this stuff for not so much.
So I guess the question, or 2 questions then. Why do we think that the crypto markets evolved this way? I have to imagine it was started probably in 2017 when tokens they didn't have that much cash, but they had crazy volatile equity, and like just the volatility of these assets was so high that it really made sense to basically sell the volatility, which was really valuable to market makers in lieu of just selling cash and paying for a service provider. But maybe what we should expect is that as the market evolves, as token pricing becomes more efficient, as the volatility of these assets decrease, it starts to eventually just look more like TradFi market making, where people don't want these weird exotic option structures. What they just want is, look, pay me 100K a year or whatever it is to market make your token. What do you think about that theory?
Like, it makes sense. Like, honestly, I'm quite surprised this option structure survived for so long. On one hand, on the other hand, like, as a market maker, working with protocol to get like $10,000 a month from them, like, it's not super lucrative. Like, it's not super interesting for most market makers. Like, nobody's going to bother with this. Like, I think another aspect of it is just like basically availability of supply. Like, in traditional markets, once the token is listed, it basically, like, even if you're not a market maker, like if you're just like a random prop trading firm, you can usually borrow those stock pretty much like on day 1 or 2 and basically trade it. There is no such borrow possibility in crypto because like all the supply is controlled, well, basically by a few market makers and, well, whatever, like maybe there was an airdrop, maybe like some investors got like early vesting. I don't know, like the availability of supply is very low and nobody would lend those tokens to anyone because it's just, I don't know, scary. Like, uncollateralized lending is pretty scary in crypto. So it's also about just market structure not being there. Like, maybe if Binance said, okay, you know what, I don't know, like, I'm just making it up, but let's say Binance comes up with new model where they say, okay, as a protocol, you don't need to have market makers. You need to give us 5% of your supply, and then we'll just, I don't know, auction it, like we'll just lend this supply to market makers on Binance, whoever pays more APY per year, for example. That would work like sort of similar to this. Like, you would not be guaranteed that you have like super liquid markets, but you'll definitely guarantee that for protocols with like interesting volumes, there will be market makers who will borrow those supply and provide liquidity that way.
Okay, well, so switching gears a little bit, and speaking of market structure, there's a new proposal for the market infrastructure bill. And this market structure bill is a successor to what was previously called FIT 21. And this bill is a total rewrite. It has a lot of things spiritually similar to the previous bill, but there's some very notable dissimilarities. So in this bill, it says very clearly of what a digital asset is and what makes a token a security or not a security. It gives oversight split between the CFTC and the SEC. CFTC is going to be responsible for the actual spot markets in crypto for tokens that aren't securities, while the SEC is going to retain authority over capital raising and fraud enforcement. There's the ability for projects to raise up to $150 million a year in tokens if they intend to decentralize. And instead of this previous quote-unquote decentralization test, there's now a quote-unquote maturity test for what they call a mature blockchain protocol. A mature blockchain protocol is one that is decentralized and or autonomous. It requires that nobody controls more than 20% of the voting power, and the value is substantially derived from the programmatic functioning of the blockchain system, and the blockchain system is impartial. It's a little vague. I didn't totally understand what the boundaries of this are, and I think it's intended to be a little bit vague, but it's not really clear what it means for a team or a small group of people to have control over this thing. Of course, there are a lot of things in crypto that have multi-sigs, that have security councils, that have upgradability. It's not clear how this would intersect with what's called a mature blockchain protocol. They also kind of push back the regulation of DeFi. So DeFi is fairly narrowly defined. Now, this is a first draft. We don't really know how this is going to be evolved over time, and almost certainly there's going to be more input that goes into this thing. But I wanted to get first reactions to the broad outlines of this bill and what a market structure bill might end up looking like. Robert, why don't we start with you? I don't know how much time you spent with the bill, but what's your first take looking at this thing?
Yeah, I haven't spent that much time with it simply because all bills evolve, and the first draft is never where it ends up. I mean, if you look at what's happening with the stablecoin legislation presently, you can see this in bright colors. I think it's going to evolve a lot. I think the definitions will change. I think some of the core structures will change. I think it's a long road between here and what gets signed into law. If this, as written, was signed into law, I think it'd be great for everybody. I think whether you're a founder, whether you're a venture investor, whether you're a market maker, whether you're an investor, whether you're a retail, you'd be like, wow, this is a great upgrade and improvement to where we were pre-market structure legislation. So I think we're at an incredible starting point. I think it's also going to change. I'm sure it'll get watered down in places. I'm sure it'll get negotiated. Right now, the Genius Act in the Senate is getting sliced and diced and compromised. All legislation goes through compromise. And this is the starting point. So would I love to see this starting point enacted as is? I sure would. Do I think we're not going to have compromise? I sure don't.
How do you handicap the odds that this bill even passes, right? I'm seeing now more skepticism about whether the market structure bill is going to work.
Yeah, I mean, there's people who know this stuff a lot better than I do. I would say as a layman, I would put its odds of passing it probably 40 to 50%.
That's period, or that's like in this year?
I think that's like period, right? Because I think we have, about a year and a half until the next elections, which will reset the game board again. And so the window is probably for major legislation is probably about a year and a half. And a year and a half are not that different. And so if we're going to do it, it's going to happen in the near term. The stablecoin legislation making its way through will be extremely illuminating for the odds of market structure, right? If we're at the end of the road with stablecoin legislation and like the Senate, finds a version of the Genius Act that they love, and then the House just generally accepts it, that will be bullish for market structure. If the House says, "Oh, we hate the Senate's version. We need to make our own things in here," and blah blah blah, and it gets stretched out, it's bearish for any crypto legislation. And so, if you want to know the outcome of the market structure, let's start with stablecoin.
We've already seen Democrats starting to have some fairly large backlash, driven in large part by the Trump family's crypto dealings. So that seems to be a very bad sign for the likelihood that we're going to get meaningful compromises on legislation anytime soon. Evgeny, what did you spend much time with this bill, and what are your thoughts and how this affects your world?
Yeah, I haven't read it like in much detail, but we definitely expect to provide feedback on this on our side, because just by virtue of us being so connected on like so many levels in crypto. I guess like my initial read is CFTC gets a lot more power compared to SEC. That's whether it's good or not. Like I'm still like trying to make my mind about this. I have to say that I really like SEC in its current iteration. So I guess like my intuition would be to give SEC in its current iteration more power, if anything. But I guess we'll wait to see.
But we do have to look beyond.
That's
4
also
years from
true.
now,
Yes,
8 years from now. So it does strike me that it's very easy for the SEC to kind of full circle if we end up getting a more inimical.
Well, yes and no. Like it depends what the law will actually say. Like if it just basically outlines the rules and like who is responsible for making rules, shows that those rules are basically followed. Like it doesn't really matter if like we have a Gensler again in like 3 years' time.
I think it really, really, really matters. I think one thing that we've learned over the last 4 years is just the range in which you can be within the bounds of the law and still have a lot of leeway to basically do what you want. And we're seeing that even now too under the Trump administration.
Okay, but it's maybe it's a bit too optimistic. But like it still would be like, okay, Gensler again would be way less damaging with a proper law around him, basically.
Less damaging. But the reality is, almost everything in crypto is complicated. It's messy. There's a lot of not everything gets colored within the lines, and certainly not of any law that I've seen that can clearly demarcate which tokens are supposed to belong where. Tom, what's your take on the market infrastructure bill?
Yeah, I mean, I guess similarly, it feels like it's very early and haven't spent a bunch of time on it, but it kind of just reminds me of how difficult it is to write good crypto legislation, where it's always too overly specific or it's not nearly specific enough. And you end up with some kludge of a solution that is not optimal. And I mean, it's true for, I guess, lawmaking in general, but crypto being amorphous and changing all the time, I feel like kind of accentuates that.
No, I agree with that. I've also, it's a very, very long bill and it's very likely to change. So I have not spent that much time with it other than reading the high level strokes. But my overall takeaway from looking at this and also knowing that, as Robert, you mentioned, I think that's probably right, is that I've heard from a few people who are closer to the DC world that they're kind of giving it 50-50 odds now that a market infrastructure bill will pass at all. And that is going to be, what it really implies most of all is that if we only get a stablecoin bill and no market structure bill, then that means it's kind of on us as an industry to self-regulate and to put ourselves in a position that we have norms that the next administration or the next set of rulemaking or next set of laws looks at what's already there and says, okay, that looks pretty good. Seems like your industry is solving its own problems. seems like this thing has become trustworthy, and we don't have to go in and rewrite all the rules and come up with some really punitive regime.
Yes,
I think
and
it mostly means balls
yes
in our
and
court.
no.
Okay,
Here's
why
where I
no?
disagree.
Give me the no.
Just to end
Give me
this,
the no.
It doesn't have to be entirely in our court. 4 years ago, the Gensler SEC could have, on its own accord, created rules for the industry through exemptive relief, through frameworks, through interpretations, through all of these different things. That never happened. That could happen under the Atkins SEC, and it could happen under a CFTC. Right? It does, they don't need legislation to create frameworks for how different securities or different assets or different items are traded. They already have the power to create frameworks. It doesn't have to come from the heavy hand of Congress. And so even if Congress doesn't act, it doesn't mean that I think it's on us and we're orphaned and we're on an island.
I don't think this is completely true, right? The SEC has said very clearly, look, we don't have the mandate from Congress, right? That's what Gensler originally said. And that's what the new SEC is saying, is that Congress needs to act in order to give us the clarity to start regulating all this shit. Otherwise, who's the regulator? Both the SEC and CFTC have said Congress has been very explicit. There's been arguments about bills, which means that nobody has clear authority. And if there's no clear authority, then look, a deferential SEC will say we're not supposed to be making rules, right? You can make rules about what are clearly.
Yes, but they can go through rulemaking, right? Formal and informal. They can. I mean, they're already doing this, releasing a lot of statements on their interpretation of different items, right? You can get a lot.
Yeah, but it's almost entirely been rollbacks, right, of things that they were previously saying or doing. And a lot of these things that we're seeing, these are speeches, right? These are not rulemaking. So far, we haven't gotten a single rule from the SEC, despite the fact that
the most basic ones that we had, Bitcoin is not a security, right? It's not like there was a law in Congress saying that Bitcoin is not security. It was a decision by SEC.
But meme coins are not securities. That's meaty and
right.
Not right.
Right. Exactly. So you can say, look, I don't think this is within my regulatory ambit, right? But you can't. But what the SEC, I mean, maybe I'm wrong, but my perception here is that the SEC is not going to say, okay, these things are not securities, and here's how they should work, right? You cannot do both. If they're not securities, they're not under the ambit of the SEC. So if you're saying, Ether movement, right? Let's say move token's not a security, right? If you say move token's not a security, then you're done. There's nothing more for you to say about it because you're not a non-securities regulator. So does the CFTC step in and say, okay, great, we're going to make the rules. And the rule is you have to disclose this, 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 and this, right? I'm not seeing the CFTC stepping up to that charge. Maybe they will, but right now, that's what both agencies are saying, is that we're waiting on Congress, and the general deference to agencies has also been ended from the Loper Bright case. So, and the overturning of the Chevron doctrine. So the whole idea is that they're supposed to shut up and wait for Congress. And if Congress doesn't act, then that means Congress intentionally does not want legislation. That's what it implies, which means that this thing stays unregulated for longer. So that's why I really do think it falls on us as an industry to solve this problem, not just for the future regulatory regime that ends up getting comported to whatever we come up with. I think it's also just good for us. It's good for us to have less movements. It's good for us to have more consumer confidence in when a token gets listed, is it something I can actually trust that I'm not going to immediately get dumped on by some fucking shady market maker?
Wintermute.
Like Wintermute. Okay, so to wrap up, Evgeny, I would really like to know, and I'm sure our audience would like to know, where do you expect crypto prices to go for the next month? I know it's all up to you, and I don't know how much you're comfortable disclosing to us, but it would really help us out a lot if you could just tell us where you guys are going to move the prices.
Yeah. Let me just flip a coin.
Floor is yours. You're going to flip a coin.
That's how I do it every day. No, I mean, it's
every day.
I'm just really horrible at predicting prices, as evidenced by my own.
You set the prices.
Yeah, why don't we do it right?
He just doesn't know what he's going to do tomorrow morning.
You don't know the dartboard.
He's unpredictable even to himself. Wow, that's you know what? That's very deep point about human nature.
I would not be long Ethereum if I could.
Long Ethereum. Okay, all right. You heard it here first. Evgeny's going to set the Ethereum price to be higher tomorrow morning. So
you heard it here on the chopping block.
Yeah, if prices go down, we're going to bring you back and accost you.
And you'll apologize to everybody.
You'll apologize to all of us.
Sounds like a plan.
Okay. All right, Evgeny, thanks for being on, shedding light on all this stuff. See you next week, everybody.